Welcome back. Today we're going to discuss options, what they are, how to do them, and why you should do them. So to take a step back, let's go to Investopedia and look at the definition for options. An options contract is an agreement between two parties to facilitate a potential transaction involving an asset at a preset price and date. Call options can be purchased as a leveraged bet on the appreciation of an asset, while put options are purchased to profit from price declines. Buying an option offers the right but not the obligation to purchase the underlying asset. So right off, options are different than futures, which people have heard of futures contracts before. Options are different than futures because when you buy a future on, let's say, wheat for September 19th, 2021, you have to follow through with that. You have to complete the transaction. With options, you don't need to complete the transaction, which is beneficial because if you are buying options, if you're gambling on the price of a stock going up or down, which we'll get into how to do that exactly later on, but if you are gambling on the price of a stock, the most you will ever lose is the amount of premium you pay if you're buying options. Now, I personally don't recommend buying options. We'll get into how to buy, how to sell options, which is what I do, and the methodology behind that, and you'll understand soon. But just for the purpose of the video, if you wanted to buy options, they're a good way to essentially limit your losses. Let's go over a few examples of why you would use options. I'm going to boot up my Robinhood account, and let's pull up Apple. Apple is a good stock. They just announced that they're going to come out with the Apple car here in a little bit. So let's say you're pretty bullish on Apple. You think that Apple car is going to take over Tesla. You could go and buy shares of Apple for $125.60 per share. If you have $1,000, you could buy 8 shares for $1,004. And then you hold your 8 shares, and if the price of Apple goes up $5 a share, you make 8 times 5, which is $40. That's pretty good. Now, let's say instead you think, okay, Apple is going to go up within the month. I think it's going to go up. Right now, the date is the 2nd of March. I think by April 1st, Apple will make its move. You can go buy, call, because remember, a call is when you're betting on the price to go up. A put is when you're betting on the price to go down. And you can buy a call, let's just say for $125.60. Let's just do, that's a current price. Let's do a $126 call. So you can spend $440, which is less than half of the $1,000 that you were gonna spend, and it would allow you to buy a call option on Apple, which expires on 4/1. So you have almost a month for the price of Apple to go up, and if it does, you will make the price of your call option, which is $440. So let's see, the break even is $130. This is why I recommend Robinhood. It will tell you what the break even is. So you will need the price of it to go up to $130 to break even. So if the price hits $130 by April, you'll get your $440 back that you spent on premium. And if it goes all the way up to, like, let's just say $135, you'll make $500 in profit. And the way you calculate that is you look at your break-even price, because you're paying $440 for premium. You look at the break-even price of $130.38, which is what the price needs to hit for you to get your premium back. And then every dollar over that you make money. So with an options contract, it gives you the right to buy 100 shares at the strike price. So if it goes all the way up to 135, that's $5 over your break even. So do 5 times 100 because you own 100 shares, and you will basically make a $500 profit if you buy this contract and if Apple goes to 135 by April 1st. So this is an expensive contract because it's Apple, but let's pick another one, CRBP. This is a cystic fibrosis medical company. Let's trade options. Let's go until, see, and they don't, since it's not as famous as Apple, they have less options for the time up here. But let's just pick April 16th. Current share price is $2.34. There's a line in the middle of my screen. Always look and put the current share price in the middle of the screen so you can see, okay, what is above and what is below. So current share price $2.34. Let's just go with and we want to change it to buy a call. Always make sure it's on the correct input. Let's just go for the $2.5 call. Let's say we want to buy a call. So let's click this. So it would cost us $55, and we have until April 16th for the stock price to rise. So, for $55, you could buy about 20 shares of this, or you can buy a call contract, a call option that will control 100 shares. And so if the price goes up to $5, your break even is $3. And so there's a $2 spread between your break even and the price of $5. Multiply 2 times 100, and that's 200. You'll make $200 in profit, and you only have to put $55 down. Now, the risk of doing this is this expiration date out here. If the price of the stock does not go to $5 or whatever price you're looking for before the expiration date, it's worthless. The $2.50 strike, which is right here, it says $2.50 call, $3 break even. What that is essentially telling you is by April 16th, if a price of a share is not above $2.50, it's 100% worthless. If it is $2.75 on or before expiration, you're still losing money because your break even is $3, but you can recover some of the premium that you paid. However, so that is why the strike price and the break even prices matter. So that, in a nutshell, is why I don't recommend buying call options or buying put options, which put options are essentially the same as calls, only you think the price is going to go down. So for that same $2.50 put, you have to pay $71, and the price has to go down to $1.79 before you even break even. But if the price went down to 79 cents, you'll make $1 past your break even, and so you'll make $100 if it goes down to 79 cents. But you have to pay up $71, and it has to happen before April 16th or whatever your expiration date is. And so for that reason, I never recommend buying options unless you think that the movement will happen within a relatively short amount of time. You're usually better off selling options instead of buying, and we'll explain why you should sell options in a second. But for buying options, it's risky because of that expiration date, which is also why selling options is beneficial, because when you sell an option, you're on the other side of the transaction and you're the one actually making the premium. I just want to leave on this. I've made a decent amount of money with options, and I've never purchased an option, buy option. I don't recommend it. It's an easy way to lose money. However, I know people who have bought call options and have made significant amounts of money just because instead of buying 1 or 2 shares of Apple, you can buy a contract to control 100 shares. And so if there's a significant price movement up or down, because you can buy put options, you can make a significant spread that you would not make if you were just buying the stock or if you were just shorting the stock. Another thing is, if you think a stock is going down, you don't want to short because of the unlimited liability that comes with shorting a stock, which I'll get into in a second. And so that is when you would buy a put option. I think there's a better reason to buy a put option than there is to short a stock. However, there's other ways of making money if you think the price is going to go down. So let's get into selling options, which is what I think you should do. So let's go back to Robinhood, and let's go to our same example of Apple. But before we get into this, we talked about buying options and selling options. I'm sorry, buying calls and buying puts if you think the price is going to go up or the price is going to go down, which is a good way of explaining why you would buy call options or buy put options. But let's take a step back and think about selling options. The best way I can describe selling options to someone is placing a limit order to buy or a limit order to sell stock that you own. So everyone, or almost everyone, has made a limit order at some point in their life for a company like Boeing or Apple or Microsoft. And you say, okay, well, Apple is at $125.59 right now. I don't want to pay that. That's a little bit too much. So I'll go like this. Boom, limit order. We'll do it for $120. And, you can set, I want it to trade in market hours or in extended hours. And we can have it good for 1 day, or we can do good until canceled up to 90 days. If you have Vanguard, it will allow you to do limit orders for 60 days. And that's essentially how you do a limit order. You're setting the price you want to pay, usually below market price, and you're just waiting. And you're waiting to see if it gets filled. You're hoping, okay, I'd like to own Apple, but I don't want to pay market price. I'll just put a limit order in and, just wait a few months and see what happens. So selling options, selling a put option and selling a call option are essentially the same as setting a limit order to sell or setting a limit order to buy. And the only difference is that when you're doing that, when you're entering into an options contract, you're dealing with someone on the other side who's gambling. They think it's going to go up or down, and so you're going to be profiting. You're getting paid doing options contracts. You're getting paid to do a limit order, and I'll show you how. So if you don't have the stock and you want to get the stock, you're going to sell a put. So selling a put requires you to have the cash in your account to do it as collateral. And selling a put essentially means that someone thinks the stock is going to go down. And you, even if you think the stock is going to go down, it doesn't matter. You just want to get paid for your limit order that you're going to put out there. So let's go for Apple, and let's go for June 18th. Let's go sell and sell a put, and let's go to $120. So if you wanted to buy Apple at $120, which is $5.61 below market price, you can put a limit order in, as I just said, or you could enter into an options contract. You could give a guy a few months. He'll give the expiration date of June 18th, because the farther out you go, the more money you make when you're selling options. And let's just pick 120 because that's a good price to pay for Apple. And then let's select one contract, because one contract gives you is equal to 100 shares. And so for this right here, you can make $713 right now in minimum credit, that's premium, that you can deposit or that you can spend immediately. If I do this deal, you need 120 times 100, so you need 12,000 in collateral in your account, and they're going to take that out from you when you enter into this contract, but you'll get the money back if it doesn't exercise. But you know, same thing with if you do a limit order on Vanguard or on Robinhood, they take that money out of your account anyway as collateral because you're doing a limit order, unless you have a margin account. So it's essentially the same as doing a limit order. The only difference is that you're getting paid for agreeing to buy Apple at a set point at a set price. And, you know, someone is betting, okay, Apple is going to go down to 110 or 105, and so I'm going to buy a put option. So they would go, okay, I'm going to buy a put option on Apple, and for June 18th, my break even is 112.87. I think it's going to go out into 105. The only downside is that you have to have 100 shares worth of collateral in your account. You need to have $12,000 for this option, but you can make $700 real quick. So that is the secret of options. That is why you should sell options, because you can get stock that is, you know, overpriced in your opinion for much less than the current market price. If I wanted to buy Boeing right now for $225, you know, I would have to pay $225, or I could sell a put for $220. Boom, I make $960 immediately, and my break even now is $210.40. And if you end up having stock and you want to sell, or let's just say you do this and you get exercised, and now you have 100 shares of Boeing, you can then just do a sell call, and the collateral will be the 100 shares that you have in your account already. So that is why you should sell options, because, you know, if you have 100 shares of Boeing and let's just say your price is $230 and you could do a limit sell for $230, why do that when you could just sell a call on Boeing and you can make $858 right now? You can pull that money out, you can spend it on shoes or whatever, and, you know, they have until April 1st, and if it doesn't go through, the contract is done and you can do it again. Or you can sell it weekly, and let's just go up to $230. You can make $127 right now for a $230 sell call on Boeing, and if it doesn't go through, you can do it again next week. So to summarize, you should always consider selling options if you want to buy a stock or if you want to sell a stock. Selling options are similar to doing a limit buy or a limit sell. The only difference is you are getting paid because someone is gambling on the other side. You can also buy options. You can buy calls or you can buy puts if you think the price of the stock is going to go up or down, and you'll make exponentially more money than you would if you bought the stock and then just held, or if you just shorted the stock. However, the issue with shorting a stock is the unlimited liability, and the issue with just buying a bunch of a stock is you have to shell out a lot of money, whereas if you just bought a call or if you just bought a put, the only thing you're out is the premium. I personally don't recommend buying calls or puts because I would rather make premium selling options. However, that's something you can do. Let me know if you guys have any questions. Leave a comment, leave a like. Join my Discord group. We talk about options all the time. It's free. If you have over $10,000 in net worth assets minus debt, we can get you into the VIP group as well. And yeah, I'm in the group every night, every day around open, and every night around 6 p.m. Los Angeles time. And you can ask your questions, and I'm here to help. We talk about everything from stocks, real estate, bonds, futures, forex. We talk about it all. Crypto. Yeah. Thank you.